$44.8 billion for mayo and mustard. McCormick is paying an insane premium for Unilever's food division.
Oh, come on. They aren't paying $44 billion. Read the structure, Nate. Unilever takes $15.7 billion in cash and keeps 65% equity. It's a spin merge, not a straight buyout.
Fair, but it just pushed Q1 deal volume to $1.3 trillion. The mega deal is officially back.
We'll see. Wait until we look at the actual integration nightmares behind that trillion. The rundown.
$1.3 trillion in Q1 alone. The mega deal is officially back from the dead.
And it's hungry. Look at Cisco swallowing Jetro Restaurant Depot. $29.1 billion. That isn't just market consolidation. That's Cisco looking at the wholesale food supply chain and deciding to buy the whole thing.
Total banker flex. You want to corner the market on bulk mayonnaise? You write a $29 billion check. But honestly, the volume numbers are what get me. A 155% spike in outbound U.S. acquisitions. Everyone's shopping overseas.
Which brings us to Danone dropping $1 billion on Huel.
Oh, I love this deal. The protein influencer economy meets legacy French dairy. It's a perfect marriage.
A perfect marriage? Nate, come on. It's a desperate legacy conglomerate buying a trendy meal replacement startup to stave off irrelevance.
Hey, survival is a valid corporate strategy.
Sure, but look at the post-merger integration data. RGP just put out a report on this so-called human value gap. 81% of CFOs say culture and talent are critical to a deal. Guess how many actually protect those assets?
I'm going to guess low. 20%?
18. You've got Danone suits trying to integrate agile startup founders who live on powdered oats and vibes. The leadership turnover is going to be a bloodbath.
Powdered oats and vibes. Put that in the pitch deck. Speaking of vibes, Playlist and EGYM finally closed their $7.5 billion merger. Connected Fitness is officially trying to pivot into corporate wellness.
Good luck selling stationary bikes to HR departments. I'm way more interested in Biogen dropping $5.6 billion in all cash for Apellis Pharmaceuticals. Pure immunology and rare disease play. No debt, just straight cash from the balance sheet.
Cash is king when you're buying pipelines. We also saw Carlyle take a majority stake in MAI Capital at a $2.8 billion valuation. The private equity roll-up of wealth management just keeps accelerating.
It really does. But if you want to talk about accelerating roll-ups and massive checks, we need to talk about the elephant in the grocery aisle.
Oh yes, $44.8 billion of pure flavor. We're getting into the McCormick and Unilever tie-up right after this. The big one. You look at that $44.8 billion enterprise value and you just have to respect the sheer gravity of it. McCormick and Unilever Foods combining is exactly what we mean when we talk about the return of the mega deal.
Oh, the mega deal is definitely back. First quarter global M&A hit $1.3 trillion, up 20% year over year. But Nate, read the actual structure on this one.
I read it. It's beautiful.
It's a reverse takeover disguised as a merger of equals. Unilever walks away with $15.7 billion in cash, plus a 65% equity stake in the new combined entity. McCormick is essentially handing over the keys to the spice cabinet.
I completely disagree. That's just brilliant structuring. Unilever gets to deconsolidate a slower growth food business, take a massive cash dividend to keep activist investors happy, and still ride the upside of a $20 billion revenue-flavored juggernaut. It's classic portfolio optimization.
Classic banker speak. You're ignoring who actually holds the power here. 65% equity means Unilever calls the shots. McCormick is paying a massive premium to be the minority partner in their own legacy.
They're getting scale. You don't get to $20 billion in revenue without making some structural compromises. Plus, it fits perfectly into this massive outbound U.S. acquisition trend. We saw a 155% spike in outbound U.S. deals this quarter. American buyers are hunting overseas, and McCormick just bagged the elephant.
Bagged the elephant or got stepped on by it? I'm looking at the post-merger integration nightmares brewing here. You've got an RGP report out this week showing 81% of CFOs admit culture and talent are critical to deal success. Guess how many actually feel they protect those assets?
I'm going to guess low, 20%.
18%. They call it the human value gap. And you're mashing together a Baltimore spice company with a massive European consumer goods conglomerate. The culture clash is going to be spectacular. They're going to squeeze this for financial synergies, and we're going to see intense leadership turnover in year one. Guaranteed.
I'll take that bet. It's still a better strategy than desperately buying relevance. Look at Danone dropping $1 billion on Huel. Traditional food brands are terrified right now. They're either merging into these massive Death Stars like McCormick, Unilever, or they're panic buying protein influencer brands to stave off irrelevance.
$1 billion for trendy meal replacements. Honestly, I'd rather bet on the Death Star. At least people will always buy mayonnaise and black pepper.
Exactly. The cash flows are bulletproof. Even if the executives completely hate each other, the grocery store shelf space is secured.
If the regulators let them keep it. Antitrust watchdogs have been notoriously brutal on consumer staples consolidation lately. They're going to tear this proxy apart.
Which means we need to talk about what happens if Washington decides this flavor juggernaut is too spicy for the free market, and what else is flying under the radar while everyone stares at the grocery aisle. Voices.
So RGP just put out this report on the so-called human value gap in M&A, and the numbers are honestly embarrassing. 81% of CFOs say culture and talent are critical to deal success. Want to guess how many actually have a plan to protect those assets?
Knowing my former brethren, maybe 30%?
18%. They are literally spending billions and then just hoping the humans figure it out.
Look, when you have $1.3 trillion in Q1 deal volume, people get sloppy. It is all mega deals and aggressive financial synergies right now. The spreadsheets look great, but then you get massive leadership turnover in year one because no one asked if the cultures actually mesh.
Okay, but I push back on the idea that it is just sloppiness from deal volume. It's structural. You don't pay $29.1 billion for Jetro Restaurant Depot, like Cisco just did, without promising your board absolute ruthless efficiency. Culture is just a casualty of the math.
But the math blows up when the talent leaves. Take Danone dropping $1 billion on Huel. You have this massive legacy French dairy conglomerate buying the absolute poster child for tech bro meal replacements.
Oh, the protein influencers are going to love the corporate integration seminars.
Exactly. You think the founder-led agile Huel team is going to survive the Danone bureaucracy? They are buying these trendy brands to stave off irrelevance, but the culture clash is going to be spectacular.
Which brings us right back to the 18%. If Danone isn't actively protecting that Huel culture, they just bought a very expensive bag of oats.
An incredibly expensive bag of oats. And speaking of expensive legacy mashups, we need to talk about what regulators are going to do with this McCormick and Unilever flavor juggernaut.
Oh, the antitrust watchdogs are already sharpening their knives for that $44.8 billion baby. Spill the tea.
$1 billion for Huel. Danone just wrote a $1 billion check for the official powdered meal of tech bros who forget to chew.
I read the press release 3 times looking for a typo. It's a phenomenal exit for the founders, but I give this integration exactly 6 months before the talent completely revolts.
Oh, come on, Maya. Danone knows how to move yogurt and bottled water at a massive scale. They can figure out influencer protein shakes. It's just a smart distribution play by a legacy conglomerate terrified of aging out of the grocery aisle.
Nate, selling Activia to my grandmother is not the same as marketing nutritionally complete sludge to a 24-year-old coder. And the data completely backs up the disaster we're about to watch. Look at the new RGP report that just dropped. 81% of CFOs claim culture and talent are critical to deal success.
Right, the standard pitch deck fluff.
Exactly, but only 18% actually protect those assets post-merger. 18. It's a massive human value gap. They get obsessed with squeezing out financial synergies, they strip out the weird startup perks, and suddenly all the key operators bounce in year one.
Okay, fair. I'll admit I'd pay good money to watch Parisian Danone executives try to mandate return to office for a bunch of Huel influencers. The Slack channels are going to be pure comedy.
The culture clash is going to be spectacular. Legacy companies buy these agile startups and immediately strangle them with corporate governance and endless synergy committees.
It's the circle of M&A life, which is why everyone is watching the legacy giants just merge with each other instead. Speaking of which, we need to talk about what antitrust watchdogs are going to do to this $44.8 billion McCormick and Unilever tie-up.
The FTC is definitely sharpening its knives for that one. Tomorrow's radar.
Tomorrow I'm watching the antitrust watchdogs. They're going to sharpen their knives over this McCormick Unilever tie-up.
Oh, come on. It's food. They aren't cornering the market on semiconductors.
It's consumer staples consolidation. The FTC loves a grocery aisle monopoly narrative. Regulators are itching to block a mega deal to prove a point.
I completely disagree. The real trend tomorrow is the cross-border shopping spree. Outbound US acquisitions are up 155%. Buyers are fleeing the FTC to hunt overseas.
Fleeing regulators or just buying actual growth?
Both. And watch the RGP report dropping tomorrow. 81% of CFOs say culture is critical to a deal, but only 18% actually protect it.
Because culture doesn't pay down the debt facility, Maya.
No, but mass resignations sure ruin your synergy models.
Fair point. I'm also watching the wealth management space. Carlyle just valued MAI at $2.8 billion. Savant and Mercer are going to counter bid soon.
We'll see who opens their wallet first. Talk to you tomorrow.